December 2001. America's seventh largest company files for bankruptcy. $63 billion gone. Thousands of employees wiped out. Wall Street shocked. But not because it happened, because no one could explain how. This is the story of Enron, the company that sold nothing, made billions, and then imploded while everyone clapped. Imagine a company that made its fortune by moving gas through pipes, not the explosive kind, the boring kind. That was Enron in 1985, just your average Houston pipeline firm formed from a merger no one outside a tax attorney's office cared about. But then came Ken Lay. He had a PhD in economics, a deep tan, and one big idea: deregulation. If the government stopped telling energy companies what to charge, Enron could go from utility company to energy trader. Suddenly, gas wasn't just pumped. It was bought, sold, hedged, and speculated on, like Wall Street, but smellier. Lay brought in Jeff Skilling, a fast-talking McKinsey consultant who believed deeply in markets, spreadsheets, and himself. Skilling's pitch? Enron wasn't just a pipeline business, it was a tech company. "We don't sell energy," he said. "We sell the future of energy." And Wall Street loved it. The real game changer came with Enron Online, a digital marketplace for trading energy contracts. It made gas trading look like ordering pizza. Click a button, move millions. Suddenly, Enron wasn't just some Texas gas firm. It was Silicon Valley with a cowboy hat. Reporters swooned. Fortune magazine crowned it most innovative company in America for 6 years straight. Inside Enron HQ, the vibe was intense. Skilling told employees they were the smartest guys in the room. Translation? If you weren't performing, you were gone. Bonuses were big, backstabbing was casual, and every quarter was a battle to impress investors. You closed 5 deals, cut costs by $20 million, boosted quarterly revenue by double digits, and landed a contract that guarantees margins through 2009? Yes, sir, all ahead of schedule. Impressive. If we were running a normal company? Enron called itself a market maker, a tech innovator, a brain trust. From the outside, it looked like the future. But ask a simple question. Wait, what do they actually do? And you'd get a shrug, a whiteboard, and 40 minutes of buzzwords. But the stock price kept rising, so no one asked again. And while the spotlight shone brighter and brighter behind the scenes, something was quietly, dangerously cracking. By the late 90s, Enron was a legend. The stock skyrocketed from $7 in 1997 to over $90 by 2000. That's over 1,000% gain in 3 years. If you bought Enron instead of groceries, you were a genius. The media called it a miracle. Executives called it a party. But behind the champagne and slide decks, the math wasn't mathing. See, Enron had made big promises. Constant growth, big numbers, no bad quarters. But energy markets aren't TikTok. They don't go viral every week. So they changed the rules. Enter mark-to-market accounting, also known as we're counting chickens that haven't even hatched and may not even be chickens. Here's how it worked. Enron signs a 10-year energy contract. Instead of waiting for actual cash to roll in, they count all 10 years of projected profit immediately. Wait, can you do that? We are doing it. So on paper, it looked like Enron was a cash machine, but many of those deals were barely profitable. Some hadn't even started yet. Others were based on projections that made astrology look conservative. Internally, it was chaos. But as long as the image held, no one dared blink. And when the numbers didn't add up, enter Andy Fastow, Enron's chief financial officer. And his main job was, well, let's call it financial storytelling. He created dozens of outside entities, called special purpose entities, or SPEs. Technically separate from Enron, but in practice, totally controlled by it. Here's the scam. Enron would take its worst assets, deals that were failing, assets that were losing value, and sell them to these SPEs. On paper, it looked like Enron was offloading risk and bringing in cash. In reality, Enron was funding both sides of the deal. It was like selling your broken car to your dog, giving him your credit card to pay for it, and then telling your wife, "Look, honey, I made a sale." He had fun naming these entities like LJM1, LJM2, and Raptor. Because nothing says totally legit companies like randomly generated names. I'm not breaking the rules. I'm using them creatively. While Fastow juggled liabilities like flaming swords, Enron's top executives were cashing out. Millions in bonuses, stock options, villas, private jets, regular Enron employees, told to pour their retirement savings into Enron stock. Their 401k plan was basically, Hail Enron. Every major Wall Street analyst still gave Enron glowing reviews, a buy rating. Many of them came from firms doing business with Enron. Merrill Lynch, for instance, made millions managing Enron's stock offerings while publicly praising its financials. Objectivity was optional. Revenue was not. The truth was buried under layers of jargon and spreadsheets designed by people who treated ethics like a software plugin. Optional, confusing, and easy to ignore. And the company encouraged that confusion. Enron's internal motto might as well have been, if you can't explain it, you're probably doing it right. By 2000, Enron's image was bulletproof, until someone finally asked, wait, where's the actual money? August 2001, Enron Tower. Jeff Skilling, CEO of the hottest company in America, walks into his office, places his resignation letter on the desk, and leaves, just like that. No scandal, no press conference, just a casual, peace out, I'm done being brilliant. Wait, what? No worries. He wants to spend more time with his millions. I mean, his family. Reality, red flag the size of Texas. That same month, the SEC launched an investigation into Enron's off-balance sheet entities, which in corporate speak means, we smell smoke, but haven't found the bodies yet. So, Ken Lay, the original gaslight alchemist, Enron's founder, returns as CEO and smiles like your grandpa after accidentally deleting your homework and says, hi everyone, it's just another Monday, business as usual. But inside the company, some people weren't buying it. One of them was Sharon Watkins, a VP who had started noticing numbers that didn't make sense. She sent a memo to Ken Lay with a blunt warning. I am incredibly nervous that we will implode in a wave of accounting scandals. An internal investigation followed, but instead of sounding the alarm, Ken Lay treated it like a PR issue. His takeaway? We just need better messaging. Not, we're committing fraud. And eventually the cracks were no longer private. A few pesky journalists and analysts begin sniffing around. They start asking questions like, why is Enron's business so confusing? Who actually owns these mysterious off-balance sheet entities? Why does their financial statement look like someone beat it with a shovel? And Enron answers with a PowerPoint, 3 buzzwords, and a middle finger. We are a revolutionary energy arbitrage trans-optimization platform. We leverage arbitrage between the notional volatility of mark-to-market derivatives within the structured energy swap framework. So, you have no idea either? Not a clue. October 2001. The mask finally slips. Enron publicly admits it made accounting errors. That's corporate speak for, we cooked the books so hard they caught fire. Turns out, $586 million in earnings weren't real. That's not a typo. That's a stage 4 fraud cancer. Investors finally wake up. Sell. Sell everything. Sell the stock, sell the couch, sell the dog. The stock collapsed from nearly $90 per share in August to under $1 by the end of November. In just 4 months, Enron lost 99% of its value. Chaos abrupt inside Enron HQ, phones ringing off the hook, executives locked in meetings, employees stared at stock tickers like their lives were flashing. Then came December 2nd, 2001. Enron filed for bankruptcy. It wasn't just a business failure. It was a financial disaster. $63 billion in assets gone. At the time, the largest corporate collapse in U.S. history. Thousands of employees, many with their retirement tied up in Enron stock, lost everything. I saved for 20 years, put every bonus into the company plan. I gave them everything. I believed in them. I am not a crook. Sure, but he did cash out $70 million before stepping down. Fastow pocketed $30 million running the scams he built. Ken Lay sold millions in stock while telling employees to hold theirs. The workers got pink slips, the execs got beach houses. But wait, wasn't someone supposed to be checking the numbers? You know, like the auditors? Enter Arthur Andersen. Once one of the Big Five accounting firms, before it became Big Four, Arthur Andersen was supposed to be the financial watchdog, the referee, the one sober person at the party. Instead, they turned out to be the ones spiking the punch at the party. Arthur Andersen wasn't just auditing Enron. They were profiting from Enron, raking in millions from consulting fees too, coaching them. That's right. The people hired to objectively review Enron's books were also advising Enron on how to cheat them. Conflict of interest? Massive. But it was the 2000s. Nobody blinked, and when the whistleblowers came forward and investigators started circling, Andersen didn't review the books. They destroyed them. Thousands of documents. FedEx boxes full of financial records, memos, and backup tapes were fed into shredders in a frenzy. Why is this thing slower than our HR department? Maybe we should just stop shredding? Stop? We've got 12 years of fraud to erase and one lunch break to do it. Should I fix the shredder? Oh, thank God, an intern. Here, start eating. We're gonna need all hands. And mouths. The firm claimed it was just part of their retention policy. But prosecutors didn't buy it. So, they were caught. Arthur Andersen was convicted of obstruction of justice. Their license to audit public companies was revoked. And just like that, 85,000 people lost their jobs. A firm that had existed for nearly a century collapsed overnight. Poof. Gone. Not for committing the fraud, but for helping and hiding the trail. And they weren't alone. JP Morgan, Citigroup, Merrill Lynch, they helped fund Enron's off-books deals, structured the lies, took their fees, cashed their bonuses. None of them faced criminal charges, but they did get slapped with hefty fines. Thankfully, the executives didn't get off so easy. Skilling and Lay were charged in 2004. Skilling was sentenced to 24 years. Lay died of a heart attack before he could serve a single day. Fastow pled guilty and got 6. Congress scrambled to pass new laws. Sarbanes-Oxley, aka Please Don't Lie, the Act. CEOs had to sign off on the numbers. Auditors had to pretend to be honest. Too little, too late. But here's the twist. This wasn't just a story about Enron. It was a story about belief, about illusion, about what happens when the world wants to believe in something so badly that they stop asking questions. For 16 years, Enron sold the future, and everyone bought in. But when the lights came on, the building was hollow, the numbers were fake, and the smartest guys in the room had vanished. As someone once said, a lie can travel halfway around the world while the truth is still putting on its shoes.